Hi everyone, today I'm going to start an exciting topic, financial accounting. Chapter 1, I'll start with chapter 1, which is called the purpose and use of financial statements. Financial statements. Okay, first we need to know what is accounting. Accounting is defined as the information system that identifies and records the economic events of an organization and then communicate them to a wide variety of interested users. Accounting, so what does it do? It identifies and records, and people who are interested in it, accounting, then it is communicated. So these are the three key points that we should remember about accounting. We should also note down that accounting is called the language of business and it has the top career opportunities in business. Then look at the users of accounting. Users of accounting. Users of accounting information can be divided broadly into two types. These are the internal users and external users. Internal users of accounting information, what does they do? They plan, organize, and run companies. These are the people who work for the company. These include the finance directors, marketing managers, human resource personnel, production supervisors, and company officers, etc. And then if you look at the external users, there are several types of external users of accounting information. They can be investors, creditors, economic planners, regulatory agencies, etc. So let's go and look onto them in details. First, in two types, internal users and external users. So what does internal users do? They plan, organize, and they run the company or the business. Examples of them are the finance, marketing, human resource, production. In finance department, they may ask, is there enough cash to pay the bills? In marketing, what price should we sell iPods for to maximize profits or to maximize our sales? In human resource, how many employees can we afford to hire this year? In production, which product line is the most profitable, etc. And then in external users, the main types are investors and creditors. So why does the investors need accounting information? Investors use accounting information to make decisions to either buy, hold, or sell their ownership interest. And creditors, such as suppliers and bankers, use information to evaluate the risks of granting credit or lending money. We should also note that there are the two main types. Like for every company, these are always there. And there are also other examples. Other examples can be labor union, then customers, tax authorities, authorities, then maybe regulatory agencies, and then economic planners. They can also be called as the stakeholders. Stakeholders are people who have certain interest about the company. Stakeholders. So let's see, look at the investors. Look at the investors' creditors. Like, investors will ask, is the company earning enough to give me a return on my investment? So if this is the business, or company, okay, this is the company, and here are the investors. So when they're investing their dollars, they are going to be asked, is the company solvent enough to give me return or profitable enough, or is their stock price increasing in the TSX or Nasdaq? And then there are the creditors. As I have said earlier, creditors will be looking at whether the company is solvent to pay back the money that the creditors will give. That is, if the company is lending the company $10, will the company be able to give it return with the interest? Yes, that's it. Until next time, thank you. See you, everyone.